got into a passive deal and was hooked and was like, okay, I love this idea, this concept, the mailbox money. I still like real estate. I still like investing, but I don't have to worry about toilets and tenants. And then got burned on bad sponsors. The biggest learning curve, that was my first foray into it. I didn't do much due diligence on the sponsor themselves. I was relying on this platform, vetting a sponsor for me, asking about hard questions. Tell me about your funds that have not gone well. If you don't have a good example of failure, then I don't want to be that example of failure.
The views expressed in this podcast are those of the individual guests and do not reflect the opinions or recommendations of Invest Clearly. This podcast is for informational purposes only and should not be considered investment advice. The appearance of a sponsor or investor on this show does not constitute an endorsement or a warning. Invest Clearly is an objective and neutral platform. Always do your own due diligence before making any investment decisions. Jeff, thank you very much for joining. It's been really awesome getting to know you and you supporting Invest Clearly. Before we really jump into things, I'd love to have you tell us a little bit about your background and ultimately the start of your journey into investing.
Thank you, Pat. Nice to meet you. My name is Jeff Revenaugh. I am a W-2 employee. I live on the West Coast, Northern California. My journey really about 20 years ago started like everybody else, got into a single family home, did some flips with a buddy from work, made a little bit of money there, and then started leveling up and and then bought a quad and then took a break, got married and saved up money to buy a house because I live in the most expensive place in the world, San Jose, California. I had to save for multiple years so I can get a down payment on a house, and then got back into it. And then at some point along the way, got into a passive deal and was hooked and was like, okay, I love this idea, this concept, the mailbox money. I still like real estate. I still like investing, but I don't have to worry about toilets and tenants. And then got burned on bad sponsors. It was just getting started. I think I was on a platform called Realty Shares, which some people have probably tried, and that flopped. And so kind of got burned by that, but got the bug. I was like, okay, This is the way to go for me. I want to retire early. This is the way to do it. Just got to find better sponsors. Yeah. And that then led me down that journey to start digging in deep and getting in a network and finding those better sponsors that can actually perform and lead deals. And so that's what's gotten me today. That's about a 20-year journey.
That's awesome. How many deals are you in currently across how many sponsors? And how is it performing? You mentioned a deal you got burned on. How's the portfolio as a whole?
Yeah, the portfolio as a whole now, I'm probably in 12 or 13 deals across probably 6 sponsors, something like that. Fortunately, the ones I got burned on that was like 10 years ago, like when Realty Shares flopped. So I've recovered from those, and they were all pretty small minimum deals. So that helped. 5,000, 10,000, that kind of thing. Yeah. How they're doing now, some of them are doing great and some aren't going great. Some have gotten burned by the interest rate, like the great interest rate hike of 2022. So that's definitely impacted some of them that are just, there's no capital calls. Thank you. But we're having a hard time just with the expenses because the loan costs have gone up. But we're breaking even and still getting some money, but definitely slowed them down.
How do you think about that, right? I talk to a lot of LPs on here, and there's a distinguishing factor between, is it the sponsor, is it the market, right? You mentioned the great interest rate hike. As you're thinking about reinvesting in some of these GPs, like how are you telling the difference where, was this a good sponsor? Did they not underwrite risk well enough? Was it them? Was it the market? What's your thoughts? Like, how do you handle that?
I remember getting into those deals and they had interest rate caps. And I didn't know what an interest rate cap was. So I looked it up and I was like, oh, okay, this makes a lot of sense. If rates go up, we have that cap in place. And so that's going to cap our risk. And so I thought that I was covered there. And we were for a year until the cap had to be so you have to buy another cap after that 12-month window. And then the caps have just become so expensive that they're prohibitive. And that was the risk there. I thought it was mitigated and it wasn't. So I think in that case, I think the intentions are well. I think they didn't expect that big of a jump in that short of a window. I don't know that any of us did. Right. Yeah. I think we all thought if rates go up, it'll be a slow, steady climb from the Fed. And it just skyrocketed up like no one had ever thought, thanks to free money from COVID or whatever happened. So that's what went wrong there. They had good intentions and they had a plan. And I didn't blink an eye at it. I didn't foresee that risk.
Yeah.
So I don't know that I blame them. Now, how they recover and how we stay afloat and manage and get through it until rates can get back down and we can get better loans.
Sure.
But it definitely now, and again, some recency bias, right? Now I'm like, okay, fixed rates. Like whoever I'm looking at, do we have fixed rate loans? And that's not always feasible either. In 5 years from now, there's going to be some value in not having those. So I don't want to overcompensate for that because of what just happened.
Yeah.
That's human nature.
Yeah. I mean, that's definitely a different narrative, what I would say, from a lot of people, like really that understanding factor moving forward about some of maybe, oh yeah, bridge debt may be attractive in the future versus like what had just happened where it's blowing everybody up at the moment. So it's a really interesting take. I guess as you're evaluating new sponsors, like what's changed over time? You went through this thing with realty shares, which you're not the only one on this podcast to bring it up. It seems to be the journey that a lot of people start with is these small allocation, I don't want to say fractional, but crowdfunding sites. Then they move into the bigger deals. What's been the biggest learning curve over the years with what happened there, as well as what's happening with the interest rates and everything else for you?
Yeah, I think the biggest learning curve, I think for me was, again, like that was my first foray into it. I didn't really do much due diligence like on the sponsor themselves, relying on this platform
Yeah.
to explain things to us and show some documentation. And they did, and they were new. And maybe they were breaking some new ground there, which I appreciate. But I think that's the learning there. The sponsor is really so important, right? Their ability and putting trust in them and really knowing that they can do it. I just didn't know what I didn't know at that point.
Yeah.
And now I've seen that go wrong and go south and rely on someone else vetting a sponsor for me. Can't do that.
Yeah.
Like we have to treat this like a business because it is a business. I'm investing in a business and I have to know that business, not how to do it, but at least who's doing it and get enough confidence and faith that they can succeed over the long run. So that was the biggest learning for me, was just pushing me into digging deeper.
Yeah, I hear that from a lot of new LPs, especially not really understanding that you're not just investing in the asset. It's not like buying your quad. You're investing in the business that's running the asset as well. And it's important. So what does that look like for you? Is the theme lately has been don't just underwrite the deal. That's what it was. Now it's really underwrite the GP or the sponsor. What does that look like for you? How are you doing that?
So how am I underwriting a sponsor? I'm certainly spending time talking to them more than in the past. I would just base it off the PPM and the operating agreement and read through that. And if and go through some check boxes in my head of what are the terms, what's the capital stack, some of those kind of like technical details. And now I'm still doing that, but I'm also talking to them and having conversations. I hate to do it, but I'm like going with my gut a little bit. Okay, do I feel after the conversation and after I've slept on it, do I feel like I trust them and do they have my best interest in mind? I'm also using a lot of AI. Right, like ChatGPT is an amazing tool now that we have. And I'll say, okay, look up any info on the sponsor, reviews, lawsuits, all that stuff. I can speed up like that investigation really fast for just, again, for all that technical info and for investor reviews. And I can tell it for content that's not on its own website, because everything on the website is going to be positive and rosy, right? So I can filter that out. So that's a game changer, I think, in our ability to do due diligence. Is really leverage that. Again, I live in Silicon Valley, so I'm like surrounded by AI all the time, every day. But I think that's the next frontier, is being able to use that as opposed to just a Google search. But it doesn't replace face-to-face call. And again, I'm not talking to the owner of the business. I'm talking to like some investor relations rep or something.
Yeah.
But asking hard questions, tell me about your funds that are not gone and what happened. What's your best deal? What's your worst deal?
How are those conversations going? Do you feel GPs will spin it in their favor? Or is it a direct and honest conversation?
I've seen both. Some were very open and honest, and it was great and refreshing. Some that kind of tried to sugarcoat it and get around it, or they don't have a good example. And I'm like, okay, if you don't have a good example of failure, then I don't want to be that example of failure.
Yeah.
So I think it's been a mixed bag, but that kind of helps separate the wheat from the chaff. It shows who's been down the road before, who's having those conversations already, who's okay and familiar with that dialogue. And that shows like a level of maturity with that sponsor.
Yeah, that's great. This episode of the Invest Clearly podcast is brought to you by Scale IR. If you're raising capital, you know the hardest part isn't just generating leads. It's turning those leads into committed investors. That's where Scale IR comes in. Scale IR transforms your investor engagement process with their proven solutions that optimize lead qualification, accelerate investor conversations, and drive higher conversions. From seamless CRM integration and intelligent workflows to expert investor qualification specialists who handle your initial discovery calls, Scale IR gives your team freedom to focus on closing deals. If you're ready to scale your investor relations and capital raising effectiveness, visit scaleir.com to learn more and book your strategy call today. Scale IR. Engage smarter, convert faster. I'd love to dive into your journey a little bit more. I've heard from plenty of LPs that have gotten smoked and then it took them out of the industry. It happened to you earlier on. What kept you in? What kept you investing after those early beats?
I was already hooked on real estate. So I'd already had maybe 10 years before that first passive deal that went south, 10 years of already hands-on real estate. I already knew, had a quad. I liked that model. I liked the diversification of that. I liked the concept of owning real estate and of renting it out, being in the path of progress and finding those deals and those areas. Like my first quad was in Reno, Nevada, because I heard that Tesla was building some big gigafactory out in the middle of the desert. And I was like, oh, that sounds like that's going to be a big hub and something that I want to get in front of. And so got in that, bought this quad like 20 minutes away and did great on it, right?
Yeah.
The factory got built and that area swarmed and we sold it in 1031. And so I like that. I was like, this is real life Monopoly. I love Monopoly as a kid. I'm like, I'm going to keep playing this the rest of my life. So I think that's what kind of got me through that and built up some of that resilience was I tasted this passive side of the deal. I was like, okay, this feels like this is my next level. And I hadn't read a book yet that kind of mapped out that leveling of kind of investor maturity. And it also was small dollars. So as my W-2 income was growing, it was less of a hit as my income was growing. I was like, okay, at least I only lost 10,000 there, 5,000 there, 15,000 there. And maybe it's just my personality. But I kind of got spurred on, like I got a taste of it. And I knew that there was better ways of doing it.
Yeah, that's great. And what are you looking at moving forward, right? You're a W-2 employee. You've got these assets on the side. Are you looking to go full-time as an LP or are you looking to balance both? What's your strategy on that?
My kids are still pretty young, so I think I am going to be balancing both for a while. But yeah, eventually it's, as opposed to retiring, it's like turning into a full-time LP and spending 20 hours a week on that, kind of managing those as I slowly transition out of W-2 life. So that's kind of where I'm at right now. It's a wait and see. I have a great job that I love and blessed to have that. So I don't have to do anything else. But
yeah,
I also, again, I think it's fun to be an LP. It's fun to get into these deals, watch them mature, watch that business model be executed and find those surprises. So I like it. So that's kind of where I'm at. I think it's going to be another 10 years.
Yeah.
It's kind of my window.
Sure. What does your investment thesis look like that aligns that and the velocity, right? For some example, a lot of people that I talk to who are trying to make this their full-time gig immediately are hyper-focused on only cash flowing deals, or they're looking at, hey, I need to purchase at least X amount of deals per year. What does that look like for you? Are you only focused on cash flow? Are you looking at like appreciation deals? Like, and even at cross asset class, like what does your thesis look like right now?
Right now, the thesis is really focused at probably like a growth in a 5 to 7 year window. So I'm looking at kind of growth funds, but I'm also doing some cash flow stuff. I'm trying to balance it out. I don't per se need the cash flow right now, but I like the security and safety of a cash flow deal. Or at least I know I'm getting that monthly paycheck. I'm getting that quarterly distribution and I can reinvest that. So it's not like it's money going away. I'm not spending it on something. I'm reinvesting it.
Yeah.
But I do like the growth stuff too, because I think for me to reach my ultimate goal, I have to have those exits, those deal exits, those 5, 7 year, 10-year hold exits. And I know that the illiquidity of a growth deal like that, the fact that I'm not getting anything for a while, that's what's really making the money. And that's what's going to make that pop at the end and get my 1.5x cash out and then reinvest that. I think in my current cycle, it's probably 3/4 growth and maybe 25% cash flow. I'm doing some kind of private credit and that stuff too. That's mostly cash flow. But I am probably 3/4 growth for this current cycle. And then when I hit that 5 to 7 year mark, when they all start exiting and they all pop, when I reinvest, then I will probably go 50-50. Maybe do one more 5 to 7 year cycle of growth and then just be all cash flow from that point. Because in retirement or in semi-retirement, I need the cash flow. That's what I want to live off of.
Sure.
I don't want to be extracting. I want to just have that base pumping out this 7%.
That's great. And how are you thinking about asset classes that aligns to that thesis? For example, you mentioned private credit. I've also heard from LPs right now, they are having a very difficult time making multifamily deals cash flow. Certain deals, others are really getting after it. What does that look like from you in terms of what you're pursuing?
Yeah, so right now I am focused on mobile home communities and self-storage. And I've been doing those for a while. I obviously started with multifamily, right? And then got into that. And some of my first passive deals were multifamily deals, kind of growth deals and some value add. And then I realized, okay, wait, but self-storage, I get a lot of that too. I think it's a little more recession resistant. And I'm not worried about tenants and stuff. It's just stuff like inside a box. There's no toilet in there, no plumbing, no power. It's like a concrete pad with metal walls and people storing their stuff. And it's a lot more sticky. I feel like people are less likely to go get their stuff out and move that around. So I like that. And then mobile home communities was my next level. I was like, this is kind of like a hybrid of both. I'm providing a house for someone, but they own their house. It's like a parking lot. Basically, it's like I own the land and I'm providing some kind of common like amenities and grass and making sure that their pad has power to it, but they own the house and they own everything inside of the house. So it's like a triple net lease for multifamily, basically.
Yeah.
With someone like living in this own house and they're responsible for all the expenses of it. So that's where I landed, and like those two. And there's a lot of mom and pop operations out there that can be taken over and added value to and stabilized, and then it's pumping cash.
Yeah.
And there's so many of that. And also no one's building more mobile home communities. No city that I know of is saying, yeah, let's go build some more mobile home parks. It's not happening. And I think and just housing affordability, I think that's a natural flow. So I think there's going to be more demand there.
Yeah, that's great. And I'm hearing and seeing like there seems to be a split. Some mobile home GPs are just absolutely getting slaughtered right now, and others are just crushing it. When you think about where these opportunities are coming from and how you find these GPs that are running these things, where are you finding them? Like what sources are you leveraging to actually get the deal flow and figure out who you should be reaching out to?
Fortunately for me, the 2 or 3 that I initially found are killing it.
Yeah,
So,
that's good.
yeah. And so I have not seen this kind of like negative side of that going south. And my first exposure to it was through a fund. So Wellings Capital was a company that was someone that I was investing with, and they were getting in that. And I basically watched that unfold and got the updates and saw the value of that. And then began looking for my own kind of sources, like instead of going through the fund, just going straight to those companies. And so for some of those, I got exposed to them through other funds and then just invested with them directly. But then there's the power of a site, Invest Clearly, that is now opening our eyes to that. It's so much easier to do research and to hear from people outside of a block of like Passive Pockets or bigger. That was the only other way to hear from people and say, hey, who are you investing in? None of my friends were investing in mobile home communities. They're like, wait, you're doing what? You sure that's a good idea? They're all stock market or just like multifamily stuff. So really had to go outside. And so that's where I feel like the value of a platform that I can start seeing reviews from real people that are doing it too, and seeing the bad ones and finding out new ones. Otherwise, it's just using Google and using ChatGPT to say, list out like profitable providers and sponsors of these kind of deals. And it's huge. There's like hundreds of them.
Yeah.
So
yeah, that's good. And as much as I'd love to promote Invest Clearly for the rest of the call, I'd love to learn. All right. So you brought up an interesting point about leveraging a fund to like a fund manager to get into your deals. I think that fund managers get a bad rap sometimes. The bad ones should, right? But the great ones are worth their weight in gold, especially when you think about access that you won't have otherwise. I guess what led you to go that path to start, right? Did you just not have the access at the time, and so you went through the fund manager to gain the access? Or what did that look like for you rather than going direct or waiting? Was it just like a test? Let me see how this goes through this person, and then I'll expand so they can help me almost supplement my skill set with underwriting and things like that. What was your mindset around leveraging a fund manager to start?
Yeah. So I would love to say that I had this awesome strategy and then I just, and I executed it, but it was just luck. I was just listening to podcasts and just hearing like different sponsors talk about their stuff in their podcasts and started looking at them and just found a few and then looked at them and that was all I knew. I was like, okay, this is cool. This is spreading. This is diversification inside of this sphere that I already like. Let's put some cash here. And again, usually starting with the minimum. Like I'm only doing like first time, just the minimum deal. That's my advice to everybody. Start off with just that kind of minimum amount and then test it and see how it goes. If you love it, then the next fund comes up and you put more into it. So I just got lucky and just got exposed and then started meeting them, right? Talking to them, having some in-person meetings with some of my fund sponsors when they're out on the West Coast for an investor call or something. And we'll go out to dinner with them, that kind of stuff. That's always great because then you get to see the name, you get to shake their hand and talk to them and really get a pretty good feel for what's going on and really develop that relationship. So yeah, I just got lucky, but it was doing some research through listening to podcasts and just reading books and getting out there and being on other websites that are bringing people together, these forums, and just asking around.
Yeah, that's great. That's great. Awesome, Jeff. We're nearing towards the end here, so I'd love to ask you the one question I like to ask on every call. What part of passive investing do you think needs to die?
Yeah, I love this question. For me, I think it's the mindset of passive, right? Like it's in the name, but this really should not be passive. I know the IRS kind of like tabs as passive because we are not active. We're not actively engaged in the business. But as investors, we have to do due diligence. We have to be involved. The sponsor's accountable. And also not just close your eyes and just blindly throw money into it. Obviously, we're not going to go fly to their headquarters and go into the office and do anything for them. But I think the mindset, there needs to be a shift there. of it, it really shouldn't be passive. These are businesses that we're investing in, and we need to treat this like our own money, like our own business that we are running, because this is our future, right? I think, like for most of us, like this is our retirement path, and this is our plan to get out of the W-2 jobs.
100%. I think that's the most, what I would say, repeated answer for this. And what's interesting is people use that as their choice, but it's defined differently each time. And I can't stress it enough. I'm very much like anti-influencer. That's how Invest Clearly came about. Not obviously people should be marketing their company, but I think passive income has been the buzzword over the last few years. That's what I think transformed. And unfortunately, it's transitioning into trust and transparency, right? Like the passive income marketing campaign is what forced the environment to what it is today. And now they're making up for it by marketing around trust and transparency. And I think, piggyback off what you said, it's not just, right? Don't take these words as face value. Is it passive on paper? Yeah, but it's not actually an action. And are you getting transparency? Yeah, maybe in the form of a marketing campaign, but like really dive into it. And that's part of the non-passive action, is really drive to make sure you are receiving transparency. And yeah, no, that's my off in a soapbox kind of stitch there. But yeah, Jeff, this has been great. If people want to get in contact with you, if you want to be contacted, where's the place to do?
Yeah, so LinkedIn's probably the best way to get a hold of me. Look me up, search me up, ping me, and talk about it.
Awesome. Jeff, thank you so much. I've really enjoyed getting to know you, and thanks for coming on. I look forward to staying in touch.
Thanks, Pat. Have a good one. See ya.
Yeah, you too. Bye.
All right, bye.
Thanks for listening to the Invest Clearly podcast. To find verified investor reviews or to claim your GP profile, please visit investclearly.com. If you enjoyed this episode, please remember to like, subscribe, and leave a review, because that's how other people find this show. Till next time, invest clearly.